Welcome back. This is the oil market review for the 6th of January. WTI prices continue to ascend and reach new weekly highs for the third consecutive week. Oil prices have been on the rise since the start of December, possibly signaling some bullish fundamentals are currently unfolding. Through this report, we aim to present the key fundamentals currently running the oil market and how they can affect the commodities price. Towards the end, we will present a technical analysis that will cover for the recent price action and levels involved. Enjoy the report. On the 5th of January, the EIA released its weekly crude oil stockpiles figure. The reading is among the top monitored by oil traders, thus its significance is in most cases mirrored with price reaction. Upon release, the indicator displayed a drawdown of minus 2.14 million barrels, which initially sent WTI prices lower, yet the commodity regained ground and stabilized shortly. This was the 6th consecutive weekly drawdown by the EIA, a fact that overall could be sending a bullish message to traders. On a similar note, on the 4th of January, the American Petroleum Institute reported its inventory levels of U.S. crude oil with a large drawdown of minus 6.43 million barrels being released. In the following minutes of the release, WTI's price gained support, as this was the largest among the last 6 consecutive drawdowns. In the US, active oil rigs continue to be on the rise and are currently at 480, as indicated by the US Baker Hughes oil rig count during the past Friday. In our view, active oil rigs are heading to 500, which can also be used as a bullish sign. Overall, the readings for the past days seem to be in line with the upward momentum by WTI prices. Moving to the OPEC front, during the group's 24th OPEC and non-OPEC ministerial meeting, the decision to adjust upward the monthly overall production by 0.4 million barrels per day starting on February 2022 was reconfirmed. The minor increase in supply by the group does not seem to impress traders, but seems to motivate some buying interest for the time being. From the decision, the OPEC group, along with its distinguished partners like Russia, seems to be sending some indirect messages that are truly worth mentioning. The current circumstances taking place around the world, with the new variant dominating media headlines, is still keeping the OPEC Plus group in a rather conservative stance, not willing to allow for excess supply to be inserted in the market. Evidently, demand has improved compared to the same time in the past year, as this is the reason prices have surged. In the beginning of January 2021, WTI prices were approximately trading at $50 per barrel, which is significantly lower than the $77 per barrel value today. Yet the fact that lockdowns are still a part of the global strategy to overcome the pandemic, the impact on the oil market can be detrimental. Even currently, oil demand could be on the back foot as the Omicron variant reels. Thus, the OPEC Plus group is forced to restrict output. As we start the new year, oil traders' focus could be shifting to some long-term view on the oil market that can possibly make it easier for them to form a trading strategy. 2022 may be a year that can possibly focus on other geopolitical matters in the oil market that remain unresolved, like the ongoing Iranian nuclear negotiations likely to be closely monitored by OPEC. In the short term, we may continue to see oil prices remaining at higher levels as demand may remain elevated, possibly countering supply, which is also expected to rise. Finally, please note the higher energy prices observed in the last part of the previous year until the present moment have created many problems around the world. Inflation levels surging globally, energy crunch in China, and the current turbulence in Kazakhstan are all related to higher energy prices. We move now to our technical analysis. Please note this is WTI's daily chart. WTI continues to be in an ascending momentum that has commenced since the 2nd of December and remains intact. After stabilization at the S1 76.30 support level that was seen as a resistance, the price action has recently broken higher, making the case for the R1 80 line to come into play. Above the R1, we tend to note the R2 82.75 level that was reached for the last time in early November. Even higher, the R3 85 line was briefly approached on the 25th of October and remains the most recent peak for WTI. If the commodity makes a turn downwards, then the S1 76.30 level can be retested. The S2 73 level remains the most possible stop if the selling is to persist further, while the S3 69.15 level at the end can be used as a support as it was on the 20th and 21st of December. The RSI indicator below our chart seems to be steadily climbing but has yet to reach 70 level. This can signal some bearish tendencies in the short term. However, as the trend in our opinion remains upwards, the commodity continues to trade in a larger sideways motion between the R3 and the S3. Thank you very much for your time and your focus. We appreciate your participation, and if you like this video, please feel free to share and subscribe. From everyone here at IronFX, wishes for solid trading.